A jam-packed market calendar and a very crowded stock market trade. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. Let's kick you off to the closing bell here in the U.S. Romaine mentioned how there's a lot on the calendar, so it's the calm before the storm of earnings, the Fed decision, and a big jobs report at the end of the week. The S&P 500 currently above 4,900, 5 points above that level. That is a record high. We are seeing prices up, yields down on the 10-year, 4.08% right now is your 10-year yield. And there is euro weakness. An ECB official signaled a rate cut could come at any time this year. That's fueling speculation something will happen in April. And crude oil had gained as much as to $79 a barrel, but then it reversed course and it's now lower. The market waiting for the U.S.'s response to a deadly drone attack in Jordan. Romaine?
Yeah, an incredibly busy and consequential week for markets, potentially one of the most consequential ones we've seen in a few months. The Fed, it decides on Wednesday, a Fed decision on what message it actually wants to send to investors. And then there's that monthly jobs report on Friday, a labor market read that will determine whether investors are actually buying what Jay Powell is selling. Now, amidst all that, we get 108 S&P companies reporting earnings, 108 of the most significant weights in the index, 108 companies representing 39% of the S&P market cap. That includes all your favorites, including Microsoft, Apple, Amazon, Boeing, and Meta, to name a few. But Andrew Garthwaite and his team of strategists over at UBS say that with stock valuations already near all-time highs, investors could be entering a, quote, difficult phase. He says the market is behaving as though weak economic data is good. And at some point, he says that relationship reverses. He adds that UBS still prefers defensive sectors, such as consumer staples and pharma, though he also says, well, some software names could be viewed as defensive as well. For now, though, UBS is out on a limb by itself. The latest Bank of America Fund Manager survey showing investors have actually pushed deeper into U.S. stocks. That positioning, now the most overweight since December 2021. Long Magnificent Seven and long duration tech. Once again, the most crowded trade out there, the bull thesis, Scarlett, centering around looser financial conditions that should be more than enough to compensate maybe for a slowdown in economic activity.
Especially if you see that idea of growth and defense at the same time. What you're describing, of course, sounds an awful lot like the first half of 2023 all over again. The dominance and outperformance of big tech. And you really see it here in this chart. It tracks the NYSE FANG Plus Index, which is the Magnificent Seven, plus 3 additional names, Netflix, Broadcom, and Snowflake, relative to the average S&P 500 member. So when this line goes up, that shows those big tech stocks, those 10 names, outperforming the equal-weighted S&P 500 index. That line went way up in early 2023. It kind of paused for the summer, but managed to grind its way higher in the fourth quarter of last year. And here's January of 2024, outperforming and driving the S&P 500 and NASDAQ 100 to new heights. Remain.
All right, let's get to some breaking news right now. A big drop in Treasury yields right now. This after the U.S. Treasury reduced its estimate for federal borrowing for the current quarter. Michael McKee joining us right now, our international economics and policy correspondent, with a readout of what we learned. Mike.
Yeah, Romaine, it's going to be a very busy week for equity investors, and bond market traders are saying, hold my beer, because they've got to take down $760 billion in marketable Treasury debt this quarter. Treasury out with its borrowing needs estimate for the first quarter of the year, January to the end of March. At the end of March, they anticipate having a cash balance of $750 billion. Now, as Romaine said, this is lower than it was first estimated to be last quarter, $55 billion lower, because they ended up with a higher cash balance than anticipated in the fourth quarter, $769 billion. So that makes up some of the difference. They also predict that they will see stronger tax receipts. In the second quarter, they're estimating they'll only have to borrow $202 billion. Still a large number for that quarter, because that's the quarter we get all our income tax payments in, so they need to borrow less, but still a lot of money. And all this, the setup for Wednesday's refunding announcement. Big news for markets when they tell us what tenors they're going to sell and how much of them. The estimate is that they're going to be increasing the size of those debt auctions, which were $48 billion in 3 years, $40 billion in 10 years, and $24 billion in 30 years. And, of course, the rest made up by money market sales. So looks like a very busy week and quarter for the bond industry as well.
And so, Mike, very quickly here, when the Treasury does make the announcement on the actual amounts of debt it's going to sell, the idea is that it should not be disruptive to markets, right?
Well, it probably won't be too disruptive, but it may have an impact depending on how much Treasury increases any one of the particular tenors. The markets are going to digest this 760 billion number, and then they'll try to figure it out, parse it out for how much gets allocated to each one. And the question will be what kind of concessions are going to be needed in order to get people to buy them. And you can see the price already going up on a number of those bonds.
All right. Mike McKee, thank you so much. Bloomberg International Economics and Policy Correspondent. And we are looking at equity stocks, equity indexes moving higher, a leg higher here for all the major indexes. And of course, Treasuries also extending their gains to the 10-year yield now at 4.307%. Let's now bring in Lucy Baldwin. She is Global Head of Markets Research and Equity Advisory over at Citi. Lucy, you heard what Mike McKee was telling us about with regards to the Treasury's borrowing needs and the refunding announcement that's coming up on Wednesday. How big a deal is this going to be for someone like you as you sift through the other data points that are coming in, whether it's earnings, the Fed decision, and of course the jobs report on Friday?
Well, as you say, there's plenty happening this week. And to try and break that down for you here, I suppose the thing that we're probably most focused on this week is going to be what we hear from the Fed. So our view, for example, is that we're going to be seeing, as we go forward, rates starting to get cut, but not until June. So as a quick recap for you, we were very bearish, really, when we came into the year. We thought we'd see a recession coming. We're pretty much the only people out there that still believe that's going to be the case. But of course, the new information over the course of the last week has been that the fourth quarter saw some very strong growth in the US in GDP terms at over 3%, about 3.3% annualized, which caught everybody by surprise. And the big question, of course, is given you've also got the core inflation measure that the Fed follows, PCE inflation, really coming under control now, 2.9% year on year in December, or actually 1.9% over 6 months annualized. The question is going to be, are you going to see the rate cuts coming? Do they come when we think, which is June, or do they come sooner than that? And obviously there was some expectations by many market participants they could come as early as March. And we think this week's data generally is going to support our view that the Fed will want to wait and see and won't want to rush and will want to tread pretty carefully to make sure inflation really is under control. So we'll be watching the Fed comments obviously on Wednesday, but also the jobs data that comes in later in the week. And we think it's going to be pretty strong jobs data coming in on Friday.
So where does that leave the debate for the markets here? If you end up with the Fed in stasis, a job market that continues to strengthen, and let's just throw out the earnings reports that we're getting this week, if those also show some relatively positive numbers and positive outlooks here, how does that change the thesis, the investment thesis going forward?
Yeah, and we've obviously had the S&P hitting 5 all-time highs in 5 consecutive trading days just recently, which I think we've only seen about 10 times since 2000. So a lot of investors asking us, exactly as you say, is it too late to get involved here in equity markets? Our answer to that is no. We still see upside coming through, and we expect this earnings season to be a pretty strong one. We think Q4 earnings are going to come through pretty strong in a number of sectors. Obviously, it's a big week for the big tech companies. And again, we're fairly confident that that set of earnings is going to come through pretty strongly. But it is worth saying that there are some risks clearly building. However, we have come through quite a notable earnings recession, particularly in the US. But our view is that we're going to start to see a broadening out from just the Magnificent Seven.
Well, that's what I'm curious about, too, because if we do get that broadening out, I would assume that has to be back on stable economic conditions. If you're of the camp, though, that economic conditions will weaken, not necessarily contract, but they'll weaken a bit here, when do we need to start looking maybe at that broadening as being, I guess, a bit of a head fake, if you will?
Yeah, I think, our view is very much that broadening is going to start to come through, particularly in sectors like the tech space, right, where the AI theme broadens out. But we also don't think it should just be about the US market. We've had this period of US exceptionalism. And I think when you look around the world, there's also tremendous opportunities in other places. I've just come back actually from Hong Kong, and we think China could be, potentially here reaching a floor in terms of valuation levels, and think, for example, that would be something for investors to look at. at. So we're going to be looking for all sorts of these kind of signs coming through in this next earnings season. And in particular, to your question, I would say, we've seen a lot of issuance activity in the credit markets to start the year. Spreads there are now pretty tight, so we'd be underweight credit, but we're pretty interested to see how that issuance gets used when companies raise that debt, to see whether companies go out and start on the M&A cycle again, because of course, as viewers will know, there's been a real quiet period in global M&A, in IPO activity, and so a better picture in terms of the earnings outlook, in terms of the economic picture, may well spur some of that activity to pick up as well, which would be one of the things that we'll be watching for as we go through the next few months.
All right, Lucy, going to have to leave it there. Great insights, great wallpaper. Lucy Baldwin, Global Head of Markets Research and Equity Advisory over at Citi, helping us kick things off to the close here on this Monday afternoon. A sit down here with the CEO of Petrobras coming up in just a bit as they announce a new 5-year strategic plan. We're going to talk to that CEO in just a second.
Plus, traders are lining up for what some are calling a once-in-a-generation bet on LatAm debt. We're going to take a closer look at what's driving these great expectations.
And a first for everything. SoFi shares rallying. This after the fintech company, well, a little less fintechy and a little bit more trad finance. We're going to take a look at 2024 and how it could be a key transition year for the company, a transition year that for right now, investors are buying into. That conversation and so much more coming up here on The Close. This is Bloomberg.
Let's turn now to what some traders are calling a once-in-a-generation emerging markets bet. This after Latin American local currency debt last year had its biggest rally since 2009, beating EMEA and Asian bonds by a wide margin. If the Fed starts easing this year, it could give another big boost to Latin American corporate bonds. Joining us now is Bloomberg emerging markets reporter Zijia Song. Zijia, a lot of this is predicated on the fact that in Latin America, the central banks are already ahead of the curve when it comes to cutting rates relative to the U.S.
Right, that's correct. So as traders are watching when the Federal Reserve will first cut rates, the central banks in Latin America already kind of embarked on that monetary easing policy. And LATAM is touted as one of the most attractive regions for EM local currency bets because in the coming weeks, 3 central banks are expected to deliver rate cuts. We have Brazil, who's probably going to deliver a half-point reduction, and then Chile, Colombia are expected to follow suit.
So does this become a little bit more about the currency, the changes to the currency as a result of those rate cuts, or is this more a bet that economic conditions and political conditions are going to do better?
So I think it can be explained from both a rates and a currency perspective. So as we are expecting Fed to cut rates, people are thinking, okay, there might be a weaker dollar environment, and that typically is a plus for EM currencies, and in turn for those EM local bonds that are denominated in these currencies, but also from a rates perspective, as long as the Fed starts cutting, that'll kind of nudge the EM central banks to start cutting as well.
I mean, when we talk about emerging markets, you have to think about China, and they are starting to make some moves to stimulate the economy, the reduction in the reserve ratio requirement. How much is that an overhang on the EM domestic debt asset class overall?
I think right now traders are actually increasingly separate China away from the rest of EM. A lot of people are making ex-China bet, and a lot of people are looking at LATAM or EMEA without the China influence. So even with China kind of having this struggle with economic recovery, and now with stimulus coming in, they're still sticking to the local currency bets.
Is there a sense, though, and I think to Scarlett's point, too, I mean, we always talk about EM as being this monolith, basically anchored by China. If you X out China, and let's just say for now, for the sake of this conversation, you X out Latin America, some of those are big rebound stories here. Is there still appetite to sort of go after some of this EM debt?
For certainly, yeah. Turkey is actually a country that kept coming up in our conversation with investors. Yeah, because it had this, Erdogan was re-elected last year, and he really changed up the policy trajectory, and there's improved economic conditions. And just last week, the Turkey Central Bank delivered its 8th straight month of rate hikes. And that ongoing tightening is luring back investors who have been staying away from the country for a while.
Yeah, that's called like a renormalization of monetary policy, if you will, in a very abnormal monetary policy nation. Zijia, great stuff, great reporting joining here Zija Song, emerging markets reporter for us at Bloomberg News. And, when I saw this story this morning, I sort of chuckled because I feel like at the start of every year, we get these grand stories about how this is EM's year.
Yeah.
And then, of course, a few months later, it turns out not to be EM's year. But when you sort of go through the details of the story, particularly with some of those Latin American nations, you can see the foundation is there potentially for a rebound.
Yes, absolutely. I mean, that's been the story all along. The narrative when it comes to LATAM is that those central banks were always kind of ahead of the Fed in terms of cutting rates. So if you get them cutting rates and then the Fed cutting rates on top of that, it's just a double boom.
All right. Yeah, a lot to cover here on the big program. Coming up, we're going to take a closer look at the shipping sector. UPS set to report quarterly results, but will they deliver? A preview of what to expect from the shipping and logistics giant when we come back right here on The Close on Bloomberg. All right, it's time now for our top calls. Some of the big movers on the back of analyst recommendations. And we're going to start it off today with Warner Brothers Discovery losing its buy equivalent rating over at Wells Fargo, a downgrade to equal weight with the analysts saying lower earnings have been the story since AT&T spun off the Warner Media division and merged it with Discovery. The analyst expects a flattish multiple and cuts to earnings estimates this year. He adds that licensing content to rival Netflix would be a double-edged sword. Shares down 2% on the day. Next up, let's take a look at Capital One, getting an upgrade to Peer Perform over at Wolfe Research with the analysts initially expecting labor market weakness and consumer credit degradation as a result of the Fed hikes. But now he can see there's clear evidence, though those risks have never materialized. He's given that's the basis for the upgrade. The shares, though, moving lower on the day by about 0.4%. And finally, let's take a look at Zim Integrated, a big shipping and services company, upgraded to buy from hold over at Jefferies, which sees cash burn shifting to cash generation. The analyst says Zim is set to capitalize from all the diversions in the Red Sea, which is tightening capacity for a lot longer than some folks had expected. Those shares having one of their best days over the last few weeks, up about 6%, and those are some of our top calls. We do want to stay in the shipping and logistics space because UPS is set to release fourth quarter results tomorrow before the bell. Our next guest says the near term could be a bit choppy, but sees some opportunities for growth longer term. Bruce Chan is the global parcel and logistics analyst over at Stifel. He's got a buy rating on UPS, and he joins us right now. All right, Bruce, let's get right to it here. I mean, what is sort of the main point that you look for out of this earnings release tomorrow?
Yeah, thanks, Romain. So I think, what's happening here in fourth quarter is we're capping off what was a pretty challenging year for freight overall, certainly for UPS, FedEx, and the parcel industry with, this upcoming report. We're going to be looking for a sign of a bottom here with average daily volumes and also some indication of where yields and pricing are going to be headed for the year ahead.
So when it comes to costs, that's going to be a big issue for UPS. The new Teamster contract certainly weighing on the bottom line over the last quarter. How are you looking at the cost structure for UPS going forward?
Yeah, well, the benefit to UPS is that the cost structure at this point is a known quantity. So what the company is going to need to be able to do is to increase pricing commensurate with those cost increases. I think the tailwind that they have at their back is FedEx is going through its own strategic revamping right now, in which it's looking to improve its own margin profile and margin structure and yield structure as well. So I think what we'll have going forward in the next, call it couple quarters, couple years, is a more disciplined pricing environment as a backdrop.
So, Bruce, when we talk about this idea here of the consumer spending cycle, how for a certain period of time it really benefited UPS, FedEx, for that matter as well, and the idea that if you believe the economic forecasters, that at least the good side of that consumer spending story continues to decelerate here, when or if does that show up materially in the earnings?
Well, I think it remains to be seen. We have a lot going on, of course, with inflation and what impact that may have on consumer discretionary spend. But I think the good thing that we have to look forward to is a lot of the shifting that we saw through 2023, normalization of what was a pretty extreme 2021 and 22 from a consumer perspective, from an inflation and inventory perspective, has started to normalize. So we can look a little bit more at the demand fundamentals at this point. But I think, as we lap the first quarter here, as we get past, the restocking season, we should start to get a better indication of what freight demand will start to look like for the year.
Right, and that'll kind of set the tone for the rest of the year. I want to go back for a moment to the disruption caused by the Teamster contract and negotiating through all of that, because UPS gave up some market share to its rivals during that time. As it tries to win back that market share and also figure out pricing, what's going to be top of mind? What is it willing to sacrifice?
Yeah, that's a really great question, and I think that's going to be one of the keys for this quarter in terms of the volatility and how earnings may shape up. UPS gained back about 40% of the volumes lost through the process of that Teamster contract by the third quarter. Management had guided towards recovering the remainder of it by the end of the year. Our reports and our channel checks suggested that discounting was quite a bit heavier than you'd see in a normal period, where you'd expect normally 10 to 15% discounting for large enterprise shippers. We were hearing reports of up to 30%. So UPS is willing to forego a little bit of short-term pricing in order to recapture some of that share, but doesn't seem that FedEx is going to let go of it very easily either. Are all the labor issues and some of the costs associated with that, Bruce, are they behind the company right now? For the most part, they are. The company had a hard-fought, I'd say not victory, but resolution of the Teamster contract. So, a lot of these issues are known now, and they can look ahead towards operating better, towards greater efficiency. The flip side of that is that, FedEx, despite being, largely non-union, has to contend with a lot of the increases. And just because they don't have a labor contract, just because they're, mostly ununionized, does not mean that they're not going to be seeing similar types of inflation.
All right, Bruce Chan, really appreciate your joining us. Bruce Chan over at Stifel giving us a preview of what to expect from UPS. And, when I think of UPS, and maybe this tells you a little bit about where my head is, I still go back to the tagline that they had for so long, which is, what can Brown do for you? They stopped using that a long time ago. Okay, I was wondering where you were going with this. No, it's now we love logistics or United Problem Solvers. That's their tagline? Yeah. Okay. United Problem Solvers. Yeah, I think we need to talk to the McKinsey consultants who came up with that one. Brown worked, right? I think, what can Brown do for you? Was a little bit more consumer friendly. Maybe they're going for a different audience, but it gets also to the idea of the mix of the business, right? Yeah. And we know how much the consumer side of the business really bolstered them, particularly going into the pandemic and obviously when we were buying everything. But at some point, there needs to be balance there. And I think that was the issue a lot of shareholders had. Yeah, absolutely. Yeah. And I mean, after a couple of really up and down years, they're looking for some kind of normalization and what that normalization looks like. I'm just impressed that you know the tagline for UPS. You know the tagline for FedEx and DHL and I don't, else? But give me 5 minutes and we'll figure that part out. All right, we've got much more coming up on the close. We're going to speak with the CEO of the Brazilian energy giant Petrobras as the company announces a new 5-year strategic plan. We're going to get insight into what Brazil's participation in OPEC means for the big energy giant. This is The Close on Bloomberg. Just about 3:30 here in New York. This is the countdown to the close. I'm Romaine Bostick. And I'm Scarlett Fu. We've got 30 minutes to go before the close, and we have a market that is rallying. It got a leg up in the last 30 minutes after the Treasury borrowing announcement. Yeah, it was interesting to see that huge spike down that we saw in yields, and of course that led to a huge spike up in asset prices because this was kind of a middling day. It looked like we were going to be relatively unchanged on the major U.S. equities, and we're now up 1% on the NASDAQ and 0.7% on the S&P. Absolutely, and in fact, the Russell 2000 gaining 1.5% as well. Of course, we'll get the devil's in the details, and we'll get the details on Wednesday morning in terms of just how much debt Treasury will be selling. But let's shift gears a little bit here from debt to commodities. Petrobras has announced a new strategic plan. The Brazilian energy giant will invest $102 billion over the next 5 years. The highlights include 72% going towards exploration and production, 16% invested in refining, transportation and marketing, and 9% heading for gas and low carbon energies, including $5.2 billion in solar and wind power. Joining us now, I'm pleased to say, is Jean-Paul Prats, CEO of Petrobras in New York. Great to see you, sir.
Thank you, Scarlett. Thank you, Romaine, for having me here in Bloomberg.
So Petrobras is making a green energy transition like so many other big energy companies. Yet, when you look at the numbers, we just mentioned a 71% increase in E&P. Explain how that 71% increase puts you on the path to green energy transition.
Well, Scarlett, transition is not rupture. Transition is something for oil companies very different from other companies. We don't change a diesel engine into a solar panel. We have to transform ourselves into something else. So it has to be done very responsibly and very fairnessly. This is what we're trying to do in Petrobras. We are 10 years late in this process. We have been 10 years almost stuck with no renewables at all and doing some decarbonization, but much less than we could do. So now this challenge of us is exactly to start this in a consistent way, in parallel to things that we already know how to do, wind energy offshore, with our offshore companies, with our offshore facilities, hydrogen parallel to gas, co-processing of biofuels into our big refineries. All this must be done in a responsible way and coherent with what we already know what to do. This is our scope right now. This is our biggest challenge, apart from recovering the credibility that Petrobras somehow got hurt years ago.
Okay, got it. So you're going to continue doing, executing on your core competencies, basically, while you move into green energy as well.
We call ourselves an oil company in transition.
An oil company in transition. Well, let's talk about the oil company part of it. How's Petrobras viewing the oil market this year? Given where oil prices are, given the disruption in the Red Sea, given the supply-demand dynamics?
I believe the disruptions will continue to exist. We are in a phase where we're not at the very end of the oil era, of course. The oil era will be probably looked at in 50 years, 40, 50 years, not now. So oil is going to be very important still in geopolitics, in the wars, in the supplies, in the logistics. I think this year will be pretty much similar to last year. We're going to be facing around the $70 to $90 barrel. We're going to be having to protect ourselves about political risks, geopolitical risks. On our side, Petrobras is pretty protected. We don't import oil from the Middle East. On the contrary, we export oil to the Far East and to Europe, so we don't use so much of the Gulf itself. And we don't import whatever we need to import still in fuels. It doesn't come from there. So we're pretty safe into that. We didn't have to deviate so much of our ships. We're pretty comfortable with that, but we have to deal with these factors as well.
So the supply chain issues haven't hit you, at least the rerouting of some of those
very few, Romain, very few, because as I said, we don't use that much of that routing. We don't use the Suez Canal, we don't use the Gulf so much as other countries.
So that doesn't need to be a concern here. You mentioned the range for oil prices potentially in that 70 to 90 here. I mean, is there anything that you see a potential catalyst that could break it out of that range, either higher or lower?
If the Yemen crisis goes farther than it's going now, if there is a rupture there, we have a very fragile neck there for oil and gas business, which is amazing because nobody was paying attention to that for decades already. You have Yemen on one side, Somalia on the other side, and nobody cares. Well, and these people are miserable, and they're looking at these super ships coming up and down, and they don't touch it. So we have to do something about that before it becomes a serious crisis. It's already on the verge of it.
How involved are you in that? And the fact that you bring that up, where at the same time you're now seeing a growing dispute between Venezuela and Guyana, of course, close neighbors of Brazil there. Have you been involved in any way here in trying to, I guess, address that dispute?
Yeah, the position of Venezuela is it's to take a position into something that historically was constructed somehow and was resolved somehow. All of a sudden you find big oil there, and everything starts again. Guyana, of course, has its borders settled. Petrobras itself is not involved in there because we're not either in Guyana or Venezuela, even though we had been in Venezuela before. Our diplomatic services and President Lula himself are getting involved into mediating a solution, which, of course, will guarantee the Guyana frontiers.
Would you be open in going back into Venezuela or entering into Guyana?
We will consider, but now with this situation, we are looking to analyze the situation itself. Guyana is a frontier that is interesting for everybody. We have some offers there. And Venezuela is the way we know. Is still a closed country with a lot of oil assets that were very depleted, very well mistreated. So there's a lot to do there once somebody gets involved seriously.
Okay, so you're keeping an eye on that market. I'm curious to hear a little bit more about Brazil's participation in OPEC and what that means for Petrobras. Is there any chance of the country actually participating in quotas at some point?
Oh, that's a very important question that maybe is worth the interview to clarify the whole world about this. There's a misunderstanding about that. Brazil is not getting into OPEC and is not going to get subject to quotas. It doesn't make sense for Brazil itself, and it doesn't make sense for Petrobras, for the government right now. All we did as a country was signing the Chart of Cooperation of OPEC Plus, which is a third degree of cooperation. It's not OPEC, it's not OPEC Plus. It's a third degree that it opened especially for Brazil and to other countries to exchange data, to cooperate, to hear the meetings, to understanding the point of view of the exporters and producers of oil amid the transition. So this is what Brazil is going to participate. Not OPEC in quotas and all that, and not even OPEC Plus. It's the OPEC Plus Chart of Cooperation.
Does it open the door, though, for investment in Petrobras from some of those OPEC Plus nations?
But that is already going on. We already have a lot of good relation with the ADNOC, with Saudi Aramco, with KPC, with the Gulf countries itself, with Nigeria, with Angola. So this is not anything that will help. It helps the dialogue. It helps the exchange of data. It will help the intelligence of Brazil about the sector, just as much as Brazil participates in so many other forums.
All right, Jean-Paul, appreciate you stopping by for us.
Thank you,
Jean-Paul Prats, he's the CEO over at Petrobras. A lot going on, of course, in the world of oil. And I thought his phrasing, the idea that they're an oil company in transition, which I guess you can say that about most oil companies. It's really now about, I guess, how fast do you want to make that transition?
Right, and doing so in a way that's sustainable and responsible and allows you to continue to fund the expansion opportunities you have when it comes to green energy.
All right, a lot more coming up here on the program. A closer look at the biggest mover of the day, SoFi, surpassing street expectations with its first ever profit. Shares jumping. That's our stock of the hour when we come back. This is The Close on Bloomberg.
We embarked on a strategy to be a one-stop shop 6 years ago for all your financial services needs. Our mission is to help people achieve financial independence, which means we have to help them get their money right. And we can't just do that in one product. We have to do it across borrowing, savings, spending, investing, and protecting.
Anthony Noto there, the CEO of SoFi, speaking on Bloomberg a little bit earlier about the fintech companies. Year of transition, and the year off to a good start so far. The shares are having their best day going back to at least July of last year. San Francisco-based firm reaching profitability for the first time since it went public. It's our stock of the hour, and Abigail Doolittle is here to walk us through why people are so excited. Let's start off here with those comments that Noto was making, because he's making it clear here that this isn't a one-off when it comes to profitability.
Agreed, that he thinks that the business is going to be strong going forward. Now, what's really interesting, this had been sort of the anti-bank bank not so long ago. Now their desire is to be one of the top 10 financial institutions. Now, relative to profitability, the reason that it did happen was because he said that they reached scale in their non-lending businesses. So about 65% of their business is straight lending. And then you have about 20%, which is the financial services, SoFi Money, Invest, SoFi Credit Card, SoFi Protection, and then about 16% their financial service platforms. They provide services to about 140 million accounts, including processing payments. So yes, he thinks that this is sustainable, and he doesn't think that this is just the only important inflection point turning profitable. He thinks also the fact that as this year goes on, it's going to be 50-50, 50 for lending, 50% lending, and then 50% for the tech platform and the financial services.
When I think of SoFi, I guess I'm stuck in 2019. I'm thinking about student loan refinancing. There was also a lot of talk about a shift into crypto. Have they given any kind of update on those businesses?
You know, I think that's in the other category, that on the financial analysis segment on the Bloomberg terminal actually is a negative -1%. So they've really transitioned. Now, when he first took over here, it was basically this lending business, but they've moved into these other areas. And the reason that he thinks that they're going to stay profitable, he thinks this scale that they've achieved, that they're going to continue to have big growth for both the financial services and the tech. They're not really looking to grow lending at this point, but he's also saying that this profitability, he was so confident about this, even in this uneven macro, which he admits to, and as a one-off, he does not think the Fed will be cutting 6 times unless unemployment goes above 5%, so a little bit of a color ahead of Wednesday in the Fed. But he thinks that their business is very predictable because they know their customers so well, and that they're just able to predict that. So for the year, they're looking at 95 to 100 million in revenue. revenue, and then 7 to 8 cents in earnings. And again, he's talking about the big thing is that the 50-50 in terms of the split between financial services and tech, and then the traditional lending business.
All right, Abigail, thank you so much. Abigail Doolittle, of course, with our stock of the hour, and that is SoFi. I loved how Abigail started off by saying it's the anti-bank. I mean, any company that kind of markets itself or positions itself as an anti-bank over the last couple of years, especially given what happened with regional banks last year, you're sitting pretty.
Yeah, pretty. And they should point out they were the anti-bank because they were also anti the regulations that came along with being a bank.
Well,
but somewhere along the line, they realized that there was profitability to be
this could work
in the trad finance area here. Everything old is new again, Scarlett.
Yes, absolutely. Yeah. You know, it's the start of a new year where you have to reposition yourself completely.
Yeah.
All right, we have about 15 minutes to go before the market close, and Romain, we have a market rally on our hands.
Yeah, we do have a market rally on our hands. Before we get to those market things, we do just want to point out the U.S. Secretary of State Antony Blinken is speaking now out there in Washington, a joint press conference with Jens Stoltenberg, the NATO Secretary General. Of course, this on the back of that very alarming news here of service members, U.S. service members being killed in a drone strike in Jordan. We'll keep an eye on that story, and we'll keep an eye on the market. This is Bloomberg.
$1.2 billion contract to produce 220.
This is the countdown to the close. Romain Bostic alongside Scarlett Fu. 10 minutes until we get to those bells. 49.21 and change on an S&P 500. Scarlett, fresh right around session highs, and that's going to be a fresh record high should we close at that level.
Yeah, and the difference was the Treasury borrowing announcement at 3 p.m. about an hour ago, which gave equities an extra lift and, of course, pushed yields lower. The 10-year coming down to 4.07%. That is down 6 basis points. Of course, we'll find out tomorrow with the actual announcement on how Treasury is going to refund itself with what tenors and how much it'll be borrowing. But that's certainly something that provided some relief for investors for now. Yeah. Euro under pressure as well.
Yeah, I think it's funny how the knee-jerk reaction is that total debt level is coming down, or new issuance level is coming down, but of course you have no idea what they're actually going to have to pay for what they issue, which I assume is going to be a little bit more.
That's tomorrow's problem.
The last round. So that spike down in yields could be a spike up, but it really shows you just how correlated right now this equity market is to what's going on in the yield space. Tracy McMillan joining us right now to talk a little bit more about this. Head of Global Asset Allocation Strategy at the Wells Fargo Investment Institute. As we count down to the close, Tracy, I'm sure you have to have your eye on what's going on in the fixed income space and the correlation that has with equities right now here. How much, credence do you give to some of these concerns here about new funding coming out of the Treasury and how that feeds into the equity market?
There's definitely been a very tight correlation between yields and how equity markets have been behaving really over the past couple of years, but we've definitely seen it so far this year. As yields come down, the equity markets tend to rally like we're seeing today. So as we get additional information from the Treasury tomorrow, we'll be looking to see if that is going to have a tightening effect on yields, or whether that is going to actually provide some relief in the form of lower interest rates, in which case that would have a positive impact on the equity markets if this correlation continues as we expect it would.
What's your general house view now on the direction of rates? I mean, we're basically at about 4.1% on the 10-year. Do you look at that and think that's going to be higher by the time we get to the end of the year, or lower?
So we think that rates are probably going to continue to move higher over the course of the year. We do have a target rate at 4.5 to 4.75% on the 10-year by the end of the year. So that's going to put a little bit of downward pressure on fixed income prices as those rates move a little higher. But we shouldn't see the kinds of negative fixed income prices that we've seen over the past couple of years. As rates do move higher, if that correlation with equities is maintained, then we could also see some pressure in the equity markets.
And when it comes to equities, you say you prefer to be defensive. Does defensive mean big tech stocks? Because they've been a form of defense for so many investors, providing shelter and safety because of their huge market share, their big cash balances. How are you thinking about that?
Yeah, for us, we're really saying that selectivity is key. And, U.S. exceptionalism is really looking more like U.S. large cap exceptionalism. Mid caps haven't participated. Small caps really haven't participated. Quality and the ability to grow earnings is really what investors are focused on here. So we've maintained an overweight to U.S. large caps, an underweight to small caps. But in terms of the sectors, we are looking at those sectors that have had significant outperformance relative to other sectors as sources of additional funds in order to rebalance into some of those sectors that have not seen the kind of valuation stretch that investment technology, communication services, consumer discretionary have seen. So we're looking at things like materials, industrials, energy, and healthcare.
So when you say that you are you have an underperform, when it comes to small caps, the gains that we saw at the end of 2023, where small caps started to participate in this overall equity rally, that ended up being a bit of a head fake. What would investors like you need to see to feel more confident in the sustainability, the durability of any kind of gains in small caps?
Yeah, I think what we would need to see is a bit of an economic slowdown, and then we would need to see indications that we are not at the late stages of a cycle as we see today. We would want to see indications that we are moving into an early cycle phase. That's when small caps tend to outperform, and that's when we want to move money from large caps into smalls.
So this gets us back to the question then, when we talk about the reaction function at the Fed, a Fed that is clearly trying to glide us down on the inflation front, something that, at least for now, seems to be occurring, whether that's because of them or something else, that's a whole nother conversation. But if we are still in that disinflationary trend, Tracy, how do you sort of reconcile, or how should the market start to reconcile all of the rate cut expectations and, more importantly, the economists' expectations for a softer economy?
Yeah, so investors are split on whether the Fed is going to start cutting rates in March. And anything that the Fed says this week that shifts those odds will have a market impact. What we are seeing in terms of inflation is that, and perhaps the Fed will address this, that there is a disconnect between core CPI and core PCE. With core CPI still running at 3.9%, we think that's probably still too high for them to cut. We think that they're going to want to see a two-handle on core CPE like they've seen on core PCE before they actually come in and start making cuts. So we see probably 3 cuts this year as opposed to the 5 or 6 that is market consensus.
All right, Tracy, always great to talk to you. Tracy McMillian there, head of global asset allocation strategy at Wells Fargo Investment Institute, helping us count down to these closing bells. Closing bells, Scarlett, now just about 3 minutes away. And you go back, I don't know, maybe 3 hours or so ago here, we were basically flat to unchanged on most of the major indices. In fact, some of the indices were in the red. That flip-flopped pretty significantly right around 3 p.m. when we got at least the start of this Treasury refunding announcement.
Yeah, this announcement that the Treasury does not need to borrow as much as some people had thought. The quarterly borrowing estimate is $760 billion. That provided a little bit of relief. We'll see whether we can maintain that momentum tomorrow when we get the details at 8:30. And of course, as the earnings start to roll in, today we get Whirlpool, which is not exactly going to move the market, but tomorrow is going to be a big one. Yeah, a big one here. Remember, more than 100 S&P companies, Microsoft tomorrow. Later in the week, we'll get Apple, Amazon, Alphabet, Meta, a lot of others. Boeing, don't forget, they report as well. Not a big market mover in terms of market cap, but certainly going to be consequential as people try to read the tea leaves as to what's going on there. We read the tea leaves for you as we count you down to the close and take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. Here to help take us Beyond the Bell. It's a global simulcast with Carol Massar and Tim Stenovic. A welcome to our audiences across our Bloomberg platforms, television, radio originals, our partnership with YouTube. Happy Monday. Great to see both of you guys here. And at least for equity traders, it's a pretty happy Monday as well.
Yeah, and it was kind of looking for most of the day, I feel like meh, until like a couple of hours ago where you saw some buying coming into the market here, pushing up all of the major equity averages. You've got the NASDAQ continuing to outperform up about 1%, but you're seeing, Tim, fairly broad-based buying in today's trade.
We just spoke with Jeff Crumpleman over at Mariner Wealth Advisors based out of Cincinnati. He's bullish, Scarlett. He says that 2024 is the year of normalcy, and we're going to return to a normal economy, normal rates of inflation and interest rates, normal supply and demand. The list goes on. You know that he said...
Is that a good thing or a bad thing?
He said it's a good thing.
Okay.
He said it's a good thing. And he actually said, you're not going to believe this.
What?
We saw that inflation actually is transitory. It was transitory. He said the T word.
I actually kind of buying into this. I mean, you know, I was on team transitory early, and then I jumped off team transitory because everyone said I was wrong. But now when you look at how much inflation has come down and how much of that actually was a function of the Fed, Fed raising rates here, I kind of agree with them, Tim.
So Jay Powell, right? He stopped saying transitory a couple of years ago.
Right. How about that?
Okay.
Transitory, it all depends on what your definition of transitory is, right? I mean, if you had to quantify it, what does that come down to?
Isn't life transitory, Scarlett? We're all just here for a moment.
Yeah, let's get philosophical here, right?
All right, we are getting the closing bells here in New York. Stocks right around session highs, and it's a big flip-flop really just in the last couple of hours of trading where it looked like we were heading for a down day. The Dow Jones Industrial Average higher by more than 200 points, or about 0.6%. The S&P 500 closing at a record high at 49.27 and change, up about 0.8%, while the Nasdaq 100 and Nasdaq Composite each higher by more than 1%. And your outperformer here on the day, that cyclical trade, back and forth today with the Russell 2000 moving higher by 1.7%.
All right, back to the S&P 500 I go, and you've got most names in the index higher, 366 to be exact, Scarlett, 135 to the downside, 2 unchanged.
And if you look at the sector performances, a lot of green on the Bloomberg IMAP when you break down the S&P 500. Consumer discretionary, tech, and communication services, those are basically the homes of big tech companies leading the way. The only real red spot there on that big pie is energy, down 0.2% as oil prices gave up early gains.
All right, everybody. We do want to get to some of the individual gainers. Just a quick headline, though, crossing. General Motors boosting its quarterly dividend to 12 cents a share from 9 cents. The estimate was for 12 cents. So coming in as what the street was expecting. All right, back to some individual gainers as we await also some earnings. Let me go to ADM, Archer Daniels Midland. It's been in the news a lot over the last week. Really an outperformer, up about 5.5%. Remember, it tanked 24% ago 1 week today, wiping about $86 billion in market value. That's after the company said it was investigating accounting practices and procedures related to its nutrition business. But again, it's among the top gainers, number one gainer, in fact, in the S&P 500 today. Moderna, also an outperformer among the S&P and NASDAQ 100 names. We'll bring it up for everybody. You can see Moderna up about 2% here, maybe almost 3% there. What's the matter? Do you want to jump in?
No.
Okay, sorry.
That's just the voices in your head, Carol. We're all just listening.
Yeah, it's a busy crowd. All right, they're up about, Moderna up about 3%. Off its highs of the session. I didn't see any real market-moving news, but Fidelity Select Pharmaceuticals portfolio making some changes. They did boost their Moderna holdings, so just throwing that out. And then SoFi, thanks to Tim pointing this out and saying, you got to do this as a gainer today. Way outperformance, surging almost up about 20%, posting its first ever profit. Go figure. The CEO, Anthony Noto, saying it's going to be a transition year for the company with technology and financial services segment driving growth instead of lending operations. So they've been really trying to right this shift. But nonetheless, SoFi, a big gainer in today's session.
Now, can I interrupt here? You missed a big one today.
Which one?
Which one?
Lucid.
Which one?
Lucid Motors. Yeah, big run up. Obviously a much smaller stock.
I was going to do 4, but then I knew you'd get on my, case.
Well, I'm adding your 4th, up 27% here.
All yours, buddy.
Carol Massar, thank you for that report. Tim, here with our decliners.
Okay, let's talk about iRobot. We've been talking about this one all day. Shares falling earlier in the session as much as 19% during the session, but closing down 8.8%. It hit its lowest intraday level going all the way back to 2009. This after Amazon and iRobot mutually agreed to terminate the August 2022 new acquisition agreement. Also in the news today.
Isn't that insane that they made that announcement August 2022?
Yes, we've been talking about
this. And this wasn't even a gigantic acquisition. This should have just been like closed in 3 months and they would have been on with it.
We talked about this with Anurag Rana and Matt Day a little earlier in the program, and they said this speaks to the trouble that the big tech companies are going to have making any acquisition if they had so much trouble with iRobot, and that's the bigger story here. iRobot's trying to right its own ship. The company's CEO is out. They're restructuring, laying off about 31% of its workforce. That's about 350 employees. So TKO Group Holdings. This is another one. The news broke on Friday. This is the parent company of WWE and UFC. Shares falling, down 4.4% after Vince McMahon announced that he's resigning as chairman following allegations of sex trafficking by a former employee. McMahon has denied the allegations but said he's stepping down, quote, out of respect for the company. Shares down 4.4% today. And WBD US, Warner Brothers Discovery, how about a media stock to round it out? Down 1.22% today. Fell as much as 3.3% earlier in the session. Wells Fargo Securities cutting its recommendation on the stock to equal weight from overweight. Wells Fargo saying it expects a flattish multiple and cuts its estimates for the year.
All right, let's take a quick look at yields. Yields had started off the session drifting lower, and then that took a huge leg lower down right around 3 p.m. when we got, I guess, the out contours of that Treasury refunding announcement, the idea that they're going to borrow less this year than they did in the previous cycle. You see the drop in yields across the curve, primarily in the belly, about 6 basis points lower on the 10-year, about 4 basis points lower on the longer end. Your 2-year yield also down about 3 to 4 basis points here. And what's going to be a week that's kind of a weird mashup of that micro and macro. Obviously, the macro will dominate, of course, with that big Fed decision on Wednesday and some big economic data, including the labor market report. But you got to overlay that on 100-plus companies, including the biggest cap-weighted companies in the S&P reporting earnings.
Yeah, going to be really important, right, when we hear what we hear from Microsoft, Amazon, Apple, and Alphabet. That's going to be certainly big in terms of market sentiment and so on. Also will be that Friday's jobs report that we will get. Do we want to do Whirlpool earnings? Should we just do that real quickly?
Yeah, let's do it.
Let's do it.
Whirlpool fourth quarter net sales, $5.1 billion almost, which is better than what analysts had anticipated, which was just under $5 billion. Fourth quarter ongoing EPS, $3.85, better than the estimated $3.71. For the full year revenue for 2024, it sees $16.9 billion. That is below what analysts had been anticipating, $17.68 billion. So that 2024 revenue forecast missing estimates might be why the stock is lower in after hours trading.
Yeah, they've been talking a lot about, weak appliance demand, sales weakness, continuing into the new year. And you do feel like this is one of those companies that's had a major reset coming off the pandemic when everybody was, redoing their homes and clamoring for all of their appliances. And it's really been a change in tone in terms of their business. And maybe, again, we talked about Jeff Crumpleman talking about going back to normal. Yeah. Is this what we're going back to, just kind of normal business for Whirlpool?
Yeah, I mean, the question is,
more?
And we spoke to the CEO a few months ago who told us that, people aren't going out and making discretionary purchases like they were a couple of years ago, Romaine. What instead they're doing is they're saying, okay, well, I need a new washer or dryer, I need a new dishwasher, but I'm not going to buy that until this one actually breaks. Whereas a couple of years ago, when they were flush with cash, they might have bought one, even if they weren't remodeling or redoing something.
Yeah, which is kind of ironic, too, when you're given how much prices on those big appliances have actually come down, at least based on the aggregate numbers that you see in those inflation reports. And it raises the question here about kind of the health of consumer spending. We keep talking about how that spending just kind of shifted to services. But if it's not going to shift back, if that cycle doesn't cycle back to goods here, what happens when services starts to falter?
All right, so I want to go back to what we started to talk about, what we get. We get a lot of big tech earnings this week. We've got a Fed meeting. We've got a jobs report on Friday. And I don't know whether that Walmart story that we got today, if you guys, I'm sure you saw it and you were talking about it, that they are possibly getting to a point where some of their store managers could make as much as $400,000. And this has to do with issuing them new stock grants, basically as a new incentive for them. And I do wonder whether that speaks once again, Scarlett, to the tightness that companies like Walmart and others are seeing continuing in the labor market.
Well, Walmart and other companies during the pandemic especially had a hard time hiring and retaining talent. So this is one of those ways that it's going to make sure that it holds on to its best employees. It should be noted that for those who work at larger stores and manage over hundreds of employees and manage the supply chain for that particular location, they're the ones who will qualify for that big bonus that gets them to $400,000.
Yeah, it's interesting to see this story now, not in 2021 when it was was so difficult for employers to find employees, but it speaks to how difficult it is for companies to attract and retain talent. I mean, the unemployment rate is still sub 4%.
Yep.
We get an update on Friday if it remains the same. But obviously, Walmart thinks that it's worth paying up in order to attract and retain the best talent.
All right, before we go, everybody happy about how the games played over the weekend, the NFL games?
I'm married to a 49er fan, diehard 49er fan.
All right, so that's good.
I'm in good shape.
What does that say about Taylor Swift, though? What does he think about the whole, like, I mean,
Is she going to perform at the halftime show?
I don't know, but I would doubt it.
I think it's
She's
Usher.
going to be busy.
Romaine, were you happy about the outcome?
You think it's Usher?
Isn't it Usher? It
What's
is
wrong with
Usher.
you? Yeah,
all right.
how dare you? How dare you?
Maybe she'll make a surprise
What
appearance.
does Taylor need to perform? That's all she did last year, just perform it.
She wants a break, is that what you're saying?
Just let her have fun with her boyfriend and take in the game and let her know. I wonder how much of a ratings boost she's going to give to the Super Bowl. Because think about all the people who aren't really into sports.
My sister is now my sister who's never watched a game of football in her life is like signing up for Peacock and watching it.
Wow.
I'm totally serious. She has a Taylor Swift jersey. She watches. Yeah, I'm like,
Peacock.
Yeah,
because it's not going to be broadcast.
Well, they had that one game that she had to catch on Peacock.
All right.
Remember that?
All right, kids, let's take this offline. All right, that's a wrap for our cross-platform coverage on radio, TV, YouTube, Bloomberg Originals. I try. It's not easy. All right, guys, we will see you again beyond the bell tomorrow.
Coming up after the break, New York Stock Exchange President Lynn Martin expecting a rebound in the IPO market. Those comments coming up right here after the break on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu with Romaine Bossack. Let's get you caught up on how markets ended this Monday. You have a banner week with, of course, earnings. You have the Fed decision. You have a jobs report. And we had the S&P 500 close at a record high, up by 0.75%, well above that 4,900 level. And, of course, at around 3 p.m., got a big leg up after the U.S. Treasury reduced its quarterly borrowing estimate to $760 billion. That also moved the 10-year yield lower to 4.07%, down 6 basis points. The Magnificent Seven put on 1.6%. 5 of the 7 companies are going to be reporting earnings this week. So that'll be critical for the rally to continue if you get those earnings coming in. And the euro weakening versus the dollar off by 0.2% as an ECB official said that a rate cut could come at any time. Let's move on to some individual movers here because earnings are in full swing and SoFi rallied as much as 24%, closing up by 20% after reaching profitability for the first time as a publicly traded company. Archer Daniels Midland had been in the news for a long time. Stock plunged 24% last week after saying it's probing some accounting practices and procedures tied to its nutrition business. But the CEO today said that the investigation into all of that is not going to materially affect the overall results. So a bit of a relief rally there. Pinduoduo, this is the American depository receipts of the Chinese online retailer, falling more than 8% as analysts blamed the decline on renewed concerns about a potential tariff on Chinese imports. Apparently, former President Trump has privately discussed with advisors the possibility of imposing a 60% tariff on all Chinese imports if reelected. That's according to the Washington Post. And Warner Brothers Discovery losing more than 1% after a bearish note from Wells Fargo, cutting its rating to the equivalent of hold from buy, saying lower earnings have been the story since the merger and the trend limits future multiples expansion. All right, let's talk a little bit more about what's going on when it comes to earnings. A big earnings week, as I mentioned earlier. 5 of the Magnificent Seven members are reporting. And so far this year, this group, which is the white line there, is up about 5% in 2024, bringing its gains over the past 12 months to 85% or so. They're holding up pretty well, in spite of the fact that Tesla, which is the blue line year, has really not kept pace, especially in 2024. Last week, of course, Tesla made really clear that it's going to have a notably lower growth rate, and now it's only up about 14.5% over the past 12 months. So you wonder, Romaine, whether this week is going to be a show me moment for the rest of the Magnificent Seven. As a group, they have a trailing PE of 41. That is double the S&P 500's multiple.
All right. Well, it could be maybe potentially a show me year for the markets. If we do get a reinvigorated slate of IPOs, that could be one of the big trends this year, according to Lynn Martin, president of the NYSE, who we talked to earlier today.
We have a tremendous amount of companies on the road. Companies are going to be more disciplined about when they tap the public markets. Obviously, they're going to want to be able to articulate a path to profitability.
And that brings us to Reddit, which is said to be weighing if it should set a target valuation of at least $5 billion for its highly anticipated IPO. Bloomberg's Bailey Lipschultz joining us right now to talk a little bit more about this. $5 billion for what is effectively a social media platform. Bailey, where are we getting this number from?
Yeah, the $5 billion number, Romaine, comes as a pretty steep haircut from where the company raised back in 2021 at $10 billion. We had reported in 2022 it was considering about $15 billion. The big thing when I talk to folks on the buy side is the fact that the likes of Pinterest and Snapchat are well below where they were back in 2021. So if you slap on some of the multiples that social media peers are generating onto Reddit, and we obviously don't really know the details of their results because that S1 hasn't flipped publicly, but when you kind of ascribe those valuations and what the buy side is looking for, that's where you hit the $5 billion bogey. We do see shares trading on private exchanges like Rainmaker and like Forge in that $4.8 billion kind of bogey, if you will.
I remember last year at this time, we were talking about Reddit going public, and that didn't obviously come to fruition in 2023. What kind of pressure is the company under to list?
I don't know if it's the pressure, Scarlett. I think it's just the fact that the company is hitting kind of a timeline where it wants to be public. We saw that last year with Instacart. It had its own issues, but trying to get out the door. Shares are down about 17% from that IPO. But we are hitting a point where a lot of these companies that we've been reporting for 2, 3, 4 years weighing IPOs are hitting a point in their life cycle that backers want them to be public. They want to start to exit those and exit those investments. And employees want to be able to really tap into the equity that they've likely built up. And Reddit is one of those companies that we're keeping a close eye on here in the early aughts of 2024.
Bailey Lipschultz, a closer look at the potential Reddit IPO here. As Lynn Martin says, this could be a big year for reinvigorating the IPO landscape. We do want to turn our focus and our attention back to bonds as the FOMC prepares to make its latest rate announcement on Wednesday. Jacques Batia joining us right now, Deputy CIO of Fixed Income at the Neuberger Berman Group. And of course, we kind of saw just how on edge these markets are today with that big drop in yields after we got that Treasury announcement here. I'm wondering, as we get deeper into the week and the actual announcement by the Fed, and more importantly, that press conference by Jay Powell, whether that has the potential to also cause a big spike either higher or lower in yields.
Yeah, I think, the volatility we've seen today and really, to start the year, we've seen, pretty much a one-way move higher in yields. We think that's going to continue this week. Obviously the jobs number will help us define growth trajectories for the U.S. But the FOMC, Powell is going to get asked, how to think about the pace of easing, whether the Fed will be willing to ease just because, if inflation is coming down or how much growth weakness would be required. So there is going to be some messaging that, as you mentioned, Romaine, at the press conference, that's likely going to drive a bit more volatility on Wednesday. And then, we've obviously got data then coming the second half of the week as well.
I am curious about sort of the relationship right now that we're seeing along the yield curve. I can still get 5.2% on a 6-month T-bill, 4.3 on a 2-year. And that's a lot more than I can get going longer out onto the curve, whether it's 10, 20, or 30 years here. It's not supposed to be that way. When do I start to get compensated for taking that duration risk?
Well, we think you are getting compensated now, and it's really the recognition that 5 1/4, 5 3/8 yield, it's not going to be around for forever. We can debate if the Fed starts easing in March or later this year or a year and a half from now. But, the nature of the bond math is that at the end of this hiking cycle, and as long as, we accept that the next move is an ease, you are, in our view, incented to, although it's optically lower yield than the cash, to lock in an elevated yield today rather than waiting. And I think that's why you're seeing a lot of support in 5-year and in maturities to start this year. The curve has been generally steepening this year. And, we think it's because investors are recognizing, the days of 5 3/8 funds rates are nearing an end, and you want to just lock in a little bit elevated yield now.
Talk about how much cash is sitting on the sidelines waiting to make a move, to take a position at this point, because there's been so much talk about how there's record cash. Are those people who are looking to make a move, or are they kind of comfortable sitting back for now?
I think we're generally seeing some of that cash starting to move this year. I think there is still a lot that is still sitting in cash. And, our best guess is some of it is going to sit there permanently. Front end rates are not going back to zero. So, our sense is that investors will probably keep some, in elevated cash holdings compared to the years of zero rates. But some of it's moving into fixed income. Some of it's probably going to move into private markets, and equities will benefit as well. But, our sense is that move has started to happen, but probably still pretty early days on it.
Got it. You had mentioned earlier, as long as we know that the next move by the Fed would be easing. Of course, one thing that's going to come up this week is any changes to the quantitative tightening schedule. How are you thinking about that, especially when it comes to how the bond market will interpret any moves to perhaps change up that quantitative tightening schedule? Is that the equivalent of easing?
Yeah, I mean, if the Fed does change the quantitative tightening schedule, that would certainly at the margin be something that would be viewed by the market as an easing and probably taken bullishly by both bonds and a lot of risk assets. But, our sense is that that's going to be more of a second half decision for the Fed, and even later, just given, the quantitative tightening is not really restricting their ability to get money market rates where they want right now. Maybe later in this year, that'll be more of an issue. But, also, the second half of this year, right, inflation will fall this first half of the year, and it will fall a fair amount. Second half, that fall will probably be a little slower. So the second half of the year with, quantitative tightening, the path of inflation, the election, there'll be a lot of, there's going to be a lot more challenges for the Fed coming, particularly 6 months from now, we think.
All right, good stuff. Ashok Bhatia, really appreciate your joining us. Ashok is with Neuberger Berman. Coming up on The Close, we talk about the top three. We focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. All right, it's time now for the top three. Every day at this time, we take a deep dive into the people at the center of the day's top stories. First up is the Smartless guys, Will Arnett, Jason Bateman, and Sean Hayes. They are moving on from Amazon. Bloomberg has learned that they've just signed a $100 million deal with SiriusXM, which will distribute and sell ads for the podcast.
How much do they get for this?
I don't know how much exactly they get individually, but we know that Amazon previously paid between $60 to $80 million. So $100 million for the overall deal this way. $100
million here for a podcast that I thought we were kind of past peak podcasts. I mean, after the whole Joe Rogan thing and some of the other big contracts we saw, and then, of course, the retrenchment for some of those companies. But I guess maybe they see some magic here that I guess will justify that cost over the long term.
They're definitely not controversial like Joe Rogan. They're kind of the opposite of that.
All right. Someone I'm keeping an eye on is Jim Esposito. He's one of Goldman Sachs' most senior executives, and he's leaving the firm after almost 3 decades. Now, this doesn't come as a big surprise. Of course, there's been a lot of speculation here about the horse race within Goldman Sachs, whether someone will replace David Solomon, some of the changes that David Solomon is making. And given how long he's been there and how high up he rose here, it's understandable that maybe he just saw the writing on the wall and said, you know what, I could find something else.
Yeah, there was reporting that he wanted a bigger role at Goldman, maybe as president or one day as CEO, as you mentioned. But David Solomon has signaled that he's not looking to go anywhere anytime soon.
Yeah, did he do like a Jamie Dimon where he's like,
five more years.
5 years, why not? And then everybody listening was like, really?
That's not going to happen. Well, yeah, Jim Esposito played a big role in merging Goldman Sachs' investment banking and trading teams in the reorganization of 2022. And notably, he was also pretty critical of Goldman's expansion into consumer banking and wanted the firm to pull back on that.
All right, our third person, who are we looking at here? Is this like another banker?
No, far from it. Brock Purdy, the San Francisco 49ers quarterback who's heading to the Super Bowl next month after last night's come-from-behind victory against the Lions. We talk a lot about how he was the last pick in the 2022 NFL draft. So he didn't have a lot of leverage, Romaine, when he signed his 4-year contract with San Francisco.
I saw they said he's basically making roughly about $900K this year. You compare that to Patrick Mahomes, who his new contract, I think, pays him something like $50 million or 40-something million.
45 million.
Whatever it is, it's multiples, of course, of what Brock goes. But let's face it here, no matter what happens, whether he wins the Super Bowl or not in a couple of weeks' time, he's getting a new contract when that 4-year deal is up, and it's going to be a lot lot more than $900,000 a year.
He's going to be the poster boy, the new poster boy for the NFL soon.
Yeah, although he's got to win. And, I know you're a 49ers fan, right? So you're rooting for him,
yes.
I take it.
And he did well. He executed. He delivered.
Yeah, we'll see. All right, well, but of course, he is not just up against Patrick Mahomes. He's also up against the juggernaut of Taylor Swift.
There you go.
All right, coming up, a look back on this day, the birth of the automobile and Mercedes-Benz. We're going to leave you with one question before we go to commercial. What was the best-selling Mercedes model in the U.S. last year? The answer when we come back. This is Bloomberg. All right, let's go back to January 29th, 1886. Carl Benz patented the one-cylinder motor wagon, widely believed to be the first ever gasoline-driven car. That same year, a model by Gottlieb Daimler and Wilhelm Maybach also debuted, and by 1926, Daimler's company and Benz's company merged and added that three-point star logo that came to be one of the most iconic representations of consumer luxury. Mercedes-Benz would go on to set numerous automotive milestones, including the first diesel passenger car and the first fuel injection car. Remember that 300 SL with the gold wing doors? But sustaining innovation over the course of a century and a half hasn't been easy. Mercedes sold about 2.5 million cars last year worldwide, but that was growth from the previous year of just about 2%. U.S. sales accounted for about 300,000 of those vehicles. And the best-selling Mercedes model last year, that was the GLC class. In fact, the GLCs have been the company's best-selling model since 2016, a year after it was introduced. But prices start today right around the less luxurious price point of about $47,000, making it one of the company's more affordable offerings. And that brings us to the big problem and our big number, 700,000. That's roughly the number of vehicles Mercedes sold in China, the company's most important market. And it's a market where it's been losing market share to not just other luxury vehicles, but to a new slate of electric vehicles as well. Remember, the engine technology and other innovations that made Mercedes synonymous with high-end luxury are now innovations commonplace across the auto industry, particularly in many of these new EVs. And it leaves Mercedes in a rare position of no longer being the cool kid in school. The solution? Lean back into what made Mercedes popular. That includes higher luxury amenities and prices. The CEO told Bloomberg just this last September that Mercedes is pursuing a strategy to bolster margins by shifting away from less profitable entry-level models like that GLC and focusing resources on top-end vehicles, including Maybach limousines, AMG performance cars, and G-Wagon off-roaders, and yes, a broader slate of EVs.
Value over volume. So we're not pushing volume. We're very, very careful about how we go to market, our go-to-market strategy. And as you can see from the results for the first 6 months of this year, that has been working quite well for us.
Interesting. So in other words, give people what Mercedes-Benz does best, which is those premium luxury vehicles, and things will work themselves out in terms of financials later on. All right, let's stick with vehicles and shift a little bit here because the annual Bloomberg NEF Summit, BNEF, kicks off tomorrow in San Francisco, and it's where automotive, energy, and technology meet to make the world cleaner and greener. For more on what to expect, let's bring in BNEF analyst Colin McCarricher, who will, of course, be giving an opening speech at the event. Colin, can you set the stage for us, set the scene for us on where we are in this journey to a cleaner transportation system?
Yeah, we're very much in the implementation phase of this journey. And a few years ago, we at Bloomberg NEF noticed that the energy sector, the automotive sector, and the technology sector were all going to different conferences, and they weren't really speaking that much. So what we decided to do is pull them all so that we could have conversations about how to get to a cleaner transport system. And so that's really what this event is. It's pulling all those stakeholders together. And as it's evolved, we've also started to include a lot more on things like shipping and aviation, which are also undergoing their own transition. Now, the move around cleaning up road transport is going the fastest, but there's progress in all areas of the transport system.
Well, let's talk about those other areas of the transport system, because I think everyone's familiar right now with what's been taking place when it comes to road vehicles. But how does what's been taking place there apply to shipping and some of those other areas?
Yeah, one of the most interesting things is that there's growing crossover between all these different sectors. So you might think, look, aviation totally separate from electric cars, but play out a scenario where there's wide-scale adoption of electric vehicles. Right now, last quarter, They cross 20% of global vehicle sales. In the US, they're a bit less, they're about 10%, including plug-in hybrids. But play that out and say that goes up a lot. Then you have a lot of ethanol that's currently going into gasoline-powered cars as a blend. That frees up a lot of that ethanol that could, in theory, be used to produce sustainable aviation fuel that can power an airplane. So all of a sudden, there are these growing crossover areas and also potentially power shipping. So there are these growing crossover areas, and those are the types of things that we're trying to explore. These areas where we're connecting the dots between topics that seem separate, but actually, as you dig into them, they're actually quite interrelated.
And I hope that exercise isn't just academic. There's money behind this. There's still investor appetite for this, Colin?
Yeah, there's real money. I mean, all the big industry players are there. They all come to the event. They're spending real money. As I said, we're not in the discussion phase about whether this is happening anymore. We're in the implementation phase. We're in the phase where governments, companies have committed large amounts of money and are spending that money. And they're trying to say, what can we do to speed this up? What can we do to make this transition to a cleaner transport system go faster? And that's one of the big topics we'll be talking about.
All right, Colin McKercher over at Bloomberg BNEF here, getting ready here for that big two-day conference taking place out west starting on Tuesday. We want to stick with this conversation and stick with climate solutions. Former NBA great Rick Fox is on a mission to help the world reduce its carbon footprint. He's one of the leaders behind Partana. It's a company that makes green concrete for builders to use as a sustainable alternative to concrete that oozes CO2 emissions into the atmosphere. Pleased to say Rick Fox joining us here in Studio 2, the co-founder and co-CEO of Partana. Rick, great to have you.
Thank you, Ramon. It's good to be here.
Let's start off here, because when we talk about how to reduce emissions, people think about vehicles, they think about factories, even farms. I'm not sure a lot of people think about concrete or the construction industry overall, but I saw a statistic actually showing that the construction industry is actually responsible as a share of probably more emissions than we get out of other industries.
38%.
Yeah.
And within that 38%, 7, 8, or 9%, depending who you speak to, that comes from cement, the production of cement, what gets us to concrete. So if we look at innovation over our lifetime, innovation of the automobile industry has happened. Other industries are evolving. I think it's time for the construction industry to evolve, and that's through the choices of being presented with better building materials.
Explain to me what green concrete actually is. I mean, what are you doing that actually takes out those emissions?
So we are actually removing and replacing cement 100% from the production of concrete. So we are a binder. If you know concrete, you know that cement is the binder that goes into production of concrete. We take cement out, we plug Partana in. And so through that process, we extract and remove all the energy-intensive nature that comes with the production of concrete, and we avoid and remove CO2 also through the process of making that concrete. So at the end of the day, we become a more nature-positive product in the building material category.
All right, I have to ask you about costs then. What are the costs of using Partana versus traditional concrete?
Right, so I would always say that depending on your size of your problem, will determine how much you're willing to pay, right? And so for us right now, in a competitive landscape of today's cement, depending where we are in the world, because cement is a commodity, you can get it at a certain price in one part of the world, you go somewhere else and it's 10 times the price. The beauty of it is that we have customers that are paying for our material at affordable housing rates, all the way up to luxury rates. So as we get to scale this year in 2024 and we build our facilities so that we can produce as much volume as we possibly can for our customers, that'll bring down our cost. But right now we're either on par with cement and we hope to be below that.
Who are your biggest customers right now?
So right now we have a partnership with Roshan out of the Middle East. Right now they're the second largest production developer in the world, looking to go to number 1. That's nice. We've worked with other individuals in the United States to date, a large hotel in Las Vegas. And we have a lot of incoming customers as well right now that are waiting for us to build one of these factories to scale.
Whenever we talk about climate issues, particularly on this show, on this network, obviously we're focused on the business, the world of business and the economy here. There's always that question here is, can people make money off this? Because without that, without some sort of buy-in from the private sector and the profit potential for that sector, they're not going to get on board with this. Is that there yet?
Yes, I think so.
Yeah.
I'm living it day to day right now. Value innovation is important. Innovation without taking it from the lab to a commercialized state where it actually is affordable for those individuals that want to make the change in a timely manner. We're getting there. And again, scaling is everything. CapEx support is everything right now. As we get to greater volumes, the prices will come down even further. And it will make it easier for people to make choices to change.
How did you get here to this, meaning this particular investment and this involvement? Obviously, you had a great career in the NBA. You went on, did a lot of stuff in Hollywood. And then when I saw your name pop up in this, I was like, really? Like what does that mean to you? Why?
What is Rick Fox doing in concrete? I was called to service. I'm from the Bahamas, a little small developing nation in the Caribbean that's on the front line of climate change. In 2019, we had a horrific hurricane that came through and destroyed 2 of our islands, displacing 30,000 citizens. And at that point in time, I have a Bahamas Relief Foundation. We donated some money, but I got really thrown into the problem. And I started to ask the question, and I started to understand that we were $11 billion in debt because of repeated storms. And when you learn that and you realize this is survival of our own country, my home country, I started to ask questions that were a little deeper than just financial contributions. It was, how can I be a part of solving this problem? Thanks to the Prime Minister of the Bahamas, who was willing to invite me and this company to come home to set up the innovation from the front line, that we got to solving one of our housing problems. We're building homes from our material, 100% produced with 0 Portland cement. We've been making these homes in the Bahamas now, and that then became a solution not only from the front line, but for the world. And so here we are now in the Middle East, in one of the largest developing countries in the world to date, that has one of the largest desalination problems in the world, and we're using that brine, instead of pumping it into the ocean, we're turning it into something of a feedstock for good. And so here we have our work cut out for us, but something that started on the front line of climate change is now something that may be a solution for the rest of the world.
Thank you for sharing that origin story. What kind of feedback do you get from potential customers in the U.S. when you tell them how it's being used right now in Bahamas?
Yeah, we're in the front line in Texas right now, excited to work with the masonry units and customers there in that state. We went into a factory there on the ground in Austin, Texas, and we plug and played, as you would say. We stepped in, and within a week, we took out all of the cement that was there being used, and we turned in and we produced products that were carbon negative with our material. That excited those builders there, and now we're looking to deliver product to customers in Texas. The more that developers in the U.S. learn about us, the more we're getting people reaching out to us. There's a number of individuals in Atlanta. So we're coming. We're excited to be here. Obviously, a lot of us in our company live here in the United States, so we're excited to continue to get this product to the U.S.
And it makes sense to start off in some place like Texas or focus on states like Florida, where they face climate change, extreme weather issues.
Exactly.
All right, Rick, thank you so much for joining us today.
Thank you.
Rick Fox is co-founder and CEO of Partana. All right, we want to, before we get going, give you a quick recap of how the markets closed on the day. It was a rally across equities and in treasuries. The S&P 500 closing at a record high above 4,900. And of course, keeping an eye on those magnificent 7 stocks, 5 of which report earnings this week, starting tomorrow. Microsoft is the big one that we're watching tomorrow, along with Alphabet. And of course, the 10-year yield, along with yields of other tenors, moving lower. The 10-year yield currently at 4.07%. We have a big Fed meeting on Wednesday, and the euro's weaker before that. This is the close on Bloomberg. Let's go now to our big take. AI, clearly one of the biggest trends over the past year. Alternative assets giant Blackstone has a strategy to invest in the space by literally investing in the spaces that will be home to thousands of computers, churning mountains of data. Bloomberg's Kara Wetzel has been covering the story, and she joins us now. She's one of the co-authors of today's big take. So tell us a little bit about this investment, Kara. Why is Blackstone getting into data centers, and what does it mean for the company?
Well, Blackstone had been looking at data centers for several years as a way to kind of benefit from the demand for cloud computing, recognizing that online was, everyone's going to need servers and space to fill them. And so they'd been really looking for a way to get into this space. This is something Blackstone does with a lot of its real estate plays, kind of finds the next big thing and then finds a landlord, directs a lot of money to that space, and just becomes a force in the industry. We've seen it with warehouses, with single-family homes, and data centers was the next big thing. So they bought a company called QTS Realty Trust in 2021, and since then have really poured a lot of money, recognizing that data centers are something that need a lot of resources to take to operate. So Blackstone has the capital to do that and has really expanded this company vastly just in the little over 2 years since they purchased it.
Is there a sense here as to what they're doing, what they're buying, what they're trying to build out here, Kara, that's going to be sustainable? That if for some reason AI, let's just say hypothetically, it turns out to be a little bit more hype than substance, is there sort of, I guess, a backup plan, a plan B for all of this real estate?
Well, Blackstone really expects that AI is going to be a huge driver of demand, and already it has been. I think they kind of, got kind of lucky with the onset of generative AI and ChatGPT, et cetera, really leading to an explosion of demand for data centers and the recognition that there's going to be a need for technologically advanced data centers that require a lot of infrastructure and power specifically. So Blackstone, now says this could be one of its best investments ever because of the onset of AI. So they're really, expecting this to be a big thing, and that they're going to continue to grow QTS, and it's going to be very profitable.
So when I saw this story, one of the first things that came to mind, of course, was all of the conspiracy theorists, the tinfoil hat people that think Blackstone somehow controls every facet of the residential real estate market. Is this now something for the tinfoil hat people to be worried about when it comes to their dominance in the data center space? We just showed a picture there of some people actually protesting one of these locations here. What's the beef?
Right. Well, QTS has become the largest operator of data centers by the least capacity of the megawatts that are used. That's how they measure data center space as opposed to square feet. But I should say that, tech companies are building their own data centers as well. Companies such as KKR and Brookfield are also getting on the game. So Blackstone, stands to be one of the biggest, but it will not be the only one. So I wouldn't say Blackstone will control everything. But, the beef is that data centers take up huge amounts of power specifically. So there's already, a shortage, a strain on the grid from the rise of data centers, crypto, et cetera, new technology. And so, a lot of the protest comes from the fact that power grids may not have the ability to support it. It'll need new infrastructure, transmission lines that will weigh on the current grid customers, so the everyday people who need to see new power lines go up in their backyard. That's really causing some of the fight. Plus just the vast amounts of space, the football field size of data centers that are going to crop up in people's neighborhoods are also spurring some backlash.
Absolutely. How far ahead is Blackstone over KKR and some of the other companies that are getting into data centers as well? You mentioned that clearly it's not the only one, but it's definitely been making inroads faster than others.
Yeah, it's just been pouring a lot of money into this company, QTS, which is the driver behind the whole thing. They have a $15 billion pipeline of development. That was up from $1 billion at the time of Blackstone's acquisition in 2021. So there's just kind of, our reporting by Don Lim, who was the lead reporter on this story, showing that, if QTS asks for cash, Blackstone will basically give it to them because Blackstone sees this as such a capital, a great investment of its capital. So when you have that and you have the big money behind Blackstone, they really can ramp ahead and get ahead and become a big leader in this space.
All right. Well, it's one of the most read stories on the Bloomberg terminal today. Blackstone betting on AI and the $25 billion empire of data centers. Kara Wetzel there helping to lead our coverage of that story. Is definitely something that's going to be talked about as we kick off a week here that is full of potential market catalysts. We're going to set you up for what to watch over the next 24 hours. Stick with us. This is Bloomberg. Start of a busy week, and probably the busiest thing, and the thing that everyone's going to be watching most, certainly tomorrow, are some big earnings. That includes Microsoft and Alphabet, more than 10% of the weighting in the S&P 500. Jackie Davilo is joining us right now, Bloomberg technology reporter, to talk about what to expect. Jackie, let's start off with Microsoft. That's the biggest weighting here. Where do expectations lie right now?
Well, investors are expecting to see a 16% increase in revenue, largely driven by partially a recovery in its BC business, which has seen pretty sluggish growth over the last year. And then also its cloud computing giant Azure. This, of course, is the company's juggernaut, the main financial engine. It's expected to see growth of about 13% in the fiscal second quarter. And it's going to see more questions, certainly from analysts looking to assess how much of an impact generative artificial intelligence has had on the Azure business, but also in some of the productivity tools, specifically Office Open 365.
Yeah, that's going to be a key question. Certainly, it's been the key catalyst for Microsoft stock over the past year or so. So when it comes to the cloud business, obviously Alphabet is a huge competitor to Microsoft in that regard. What do we know about Alphabet's cloud business and how quickly it's growing there, whether it's gaining share on Microsoft and Amazon?
Google is a story that it's twofold. You had a pretty rocky quarter last period where you saw those cloud figures come in below expectations, even though that unit has seen major tailwinds from the AI boom. It's gotten good business from AI startups that are looking to do some of these workloads on the cloud. Investors are going to see, is generative AI really paying off for the company? This unit is one of those areas where it can look to for that proof. Another area that is going to be key for the company is its search advertising business. It's the company's main financial engine as well. Is it still holding up? But also, are you seeing any benefits coming from search optimization that are coming as a result of generative AI features? It might still be too early to tell, but investors want to see at least early signs. Also in its YouTube revenue, it's sort of kind of taken a little bit of a hit in the past quarters, but generative AI could really see give it a big boost there as well.
All right, nice preview there. Jackie Davalos, technology reporter, is going to be very busy tomorrow afternoon. Of course, we'll be busy as well. A full coverage.
I was just going to say, what are we going to do? We're going to be breaking down the earnings.
Yeah, full coverage of those earnings after the bell tomorrow. Microsoft and Alphabet, I was just looking, Microsoft 7% of the market cap of the S&P 500, and you add up the 2 shares of Alphabet, and that's about 4% here. So potential market moving depending on how those earnings shake out. There are some other things happening as well, things you need to watch over the next 24 hours, and that includes Baker Hughes, a big meeting there.
Yeah, they're holding their annual meeting in Florence, Italy. That's why Alex Steele is not here. She's attending that annual meeting, so we'll hope to get some commentary from her and the folks that she speaks with. Let's stay with Europe because there's also key data coming out there.
Yeah, we actually are going to get some of that growth data coming out of Europe, and we know the growth story over there versus what we're seeing here in the U.S., at least in theory, if you believe the economists, going in much different tracks.
Absolutely, and that's why a lot of people are saying that the European Central Bank will be pushed to cut rates a lot earlier than the U.S. Perhaps, as one ECB official put it, any time is on the table right now.
Yeah, interesting. And you mentioned, of course, the ECB rate decision from last week, and of course, we get a big Fed decision this Wednesday. But before we get there, a lot of earnings tomorrow. We start before the bell with UPS, JetBlue, and a few others.
JetBlue, of course, it will be interesting given that it is appealing the DOJ decision to block its merger with Spirit. There's also Cisco and Pfizer. Pfizer has been under some pressure, we know, as it tries to transition out of the vaccine business.
And after the bell here, Electronic Arts, AMD, Microsoft, Starbucks. Of course, that's in addition to Alphabet as well. Which one you're most interested in?
I'm interested in Microsoft because it's the leading edge of what's going on with AI.
Absolutely. Leading edge and biggest weighting in the S&P. Scarlett and I will be back with full coverage of that tomorrow after the bell. But stick around. Balance of Power coming up next here on Bloomberg.